morning, ladies and gentlemen. Thank you, Andrew, and the organisers of the conference for inviting me to participate in this. And although Mr. Howard isn't here at the moment, can I also acknowledge the honour of being in his presence? And in the context of the remarks I want to make, I want to say that one of the reasons why I've personally respected Mr. Howard for so long, since he was Treasurer in the Fraser government, is that he's been one of the few people responsible for economic management, among other things, who's been willing to engage openly with people who have different points of view on aspects of economic management without regarding them, if they have different points of view, as enemies for life. And that's a characteristic that sadly he shares with few other leaders and political figures, and that is in turn to the detriment of the kind of debate about economic management that I believe, if we had more of it, would lead to better economic management and better economic outcomes for the people of Australia. And I want to say that in the context of some of the remarks that I'm going to share with you this morning. The theme of this conference is about crisis management, as you heard from Andrew's introduction this morning and from Paul's keynote address. But in my view, I'm not sure that the term crisis management really applies to economic or fiscal management under the Howard government. I listened carefully to the list of crises that Paul adumbrated in his keynote address, and of course none of them were economic or fiscal. The truth is, I don't think there were any domestic economic or fiscal crises during the period of the Howard government, 11 years in office, and indeed that is something that's to the Howard government's credit, that there weren't any serious economic crises during its term in office. There were certainly some economic challenges that occurred globally during the 11 years for which the Howard government was in office, and the term crisis was appended to a couple of those: the Asian financial crisis of 1997-98, the very brief, but nonetheless, at least for the United States financial market, serious crisis associated with the collapse of LTCM, long-term capital management, in 1998. And although the term crisis wasn't generally applied to it, the tech wreck of the early 2000s following the collapse of the NASDAQ and other high-tech stock markets and the end of the bubble, of which that was the most prominent feature, certainly caused recessions in the United States, many other Asian economies and in Europe, but we managed to avoid having that here. So as I say, it's to the Howard government's credit that we didn't have any economic or fiscal crises in Australia during its term in office. I'd also note in this context that for many leaders, crises create opportunities to implement economic reforms that may not be politically feasible otherwise. Jeff Kennett's reforms, for example, is an instance of that. So the fact that the Howard government was able to implement some significant economic reforms, in particular the introduction of the GST and the associated changes to the federal and some state tax systems, without the background of a crisis to create a burning platform for it, does also tell you something about the Howard government's political skills and its capacity to persuade the electorate of the arguments for reform, at least in its first two terms of office. Because I am going to make some critical remarks about aspects of the Howard government performance in this presentation, if I can get the slide to move, I want to set it in a particular context, which is that the Howard government has, at least in a statistical respect, the best economic track record of any Australian government in the last 50 years. Real GDP growth was stronger during the period in which the Howard government was in office than it was under any other government. Even if you abstract from the impact of population growth, Economic growth was faster under the Howard government than under any other government in the past 50 years. Employment growth was faster than under any other government in the past 50 years. The unemployment rate fell by more during the term of the Howard government than it has done under any other government in the last 50 years. John Howard was right when he said from time to time that real wages grew faster during his term in office than any other government in the last 50 years, except for the Whitlam government, when real wages rose far too fast relative to productivity and contributed to the significant increase in unemployment that occurred during that period. Whereas under the Howard government, productivity growth was faster than it had been under any previous or subsequent government. Mr. Howard was always generous enough to acknowledge that some of that was due to reforms implemented by the Hawke and Keating governments, although again there it's worth noting, and I've always felt that one of Mr. Howard's greatest services to the nation was the fact that during his period as opposition leader he didn't oppose reforms which the Hawke and Keating governments had advocated, even though there might have been short-term political advantage in doing so, because he recognised that those reforms were in the national interest. Of course, the Howard government also implemented some of its own productivity-enhancing reforms, including, as we've just heard and we'll hear in more detail, reforms that significantly improved the productivity of Australia's waterfront experience. In two other important respects, the Howard government's economic management has no peer. The Howard government presided over larger reductions in both inflation and interest rates than any other government during the past 50 years, if we can have that chart of interest rates come up as well. Now, in many cases, that wasn't entirely due to decisions made by the Howard government during its period in office. In some ways, the comparisons that are often made of what happens to various economic indicators during a particular government's period in office tend to assume that everything that happens during that period in office is entirely the result of decisions that that government has made and has had nothing to do with government decisions that previous governments have made, or with things that are entirely beyond the control of any Australian government. The Howard government's very good economic track record did benefit from, in particular, three entirely fortuitous external developments. One was the extraordinary improvement in Australia's terms of trade that actually started towards the end of the period of the Keating government and continued beyond the end of the Howard government's term in office. But Australia was one of the few Western countries that benefited from the rapid economic growth and industrialisation of China during the period in which it became Australia's most important trading partner. For most other Western economies who, like China, are importers of commodities and exporters of manufactured goods, China's emergence as the biggest importer of commodities and exporter of manufactured goods in the world made their terms of trade worse. It pushed up the price of the things they import and pushed down the price of the things that they export, or competed them out of that space altogether. But for Australia, as one of the few advanced economies that's an exporter of commodities and an importer of manufactured goods, China's economic development during and slightly before and after the period of the Howard government was, in almost every respect, an unalloyed blessing. The Howard government also benefited from the significant decline in the Australian exchange rate that had begun under the previous government but reached its nadir, if that's the right word, during the second and third terms of the Howard government. That greatly enhanced Australia's international competitiveness, was of particular benefit to regional Australia as the source of most of Australia's exports. The Howard government can certainly claim credit for the fact that this big fall in the exchange rate did not result in increased inflation or significant increases in interest rates, as it had done during previous periods of a weaker exchange rate. Instead, it assisted the growth in the Australian economy, and as we'll see, it helped improve the Australian budget. Third, the decline in interest rates that occurred during the period of the Howard government, and for that matter, the parallel decline in inflation, also owed a lot to global circumstances. The Howard government was in office during the period that economists know as the Great Moderation. That is, when, almost irrespective of what governments did with regard to their budget deficits, inflation and interest rates remained both low and stable. And that was undoubtedly a factor in Australia's experience of low and stable inflation under the Howard government, although I would also say that one of the more important decisions that the Howard government made very early in its first term to grant formal independence to the Reserve Bank was another critical ingredient in Australia's capacity to sustain low and stable inflation in the face of, as you can see, a very volatile exchange rate. Turning more specifically to the issue of budget management, the Howard government's record in managing Australia's public finances is, I think, in a statistical sense, without parallel. As you can see from this chart, it's the only government in the last 45 years which has run budget surpluses on average over the term of its office. It might come as a surprise to see the statistics saying that the Whitlam government ran a budget surplus during its term in office, but that's using the contemporary definitions of underlying budget balance, which exclude advances to states and territories, which were included in the measures of budget deficits during the Whitlam years, and for that matter during the period when John Howard was Treasurer under the Fraser government. But reflecting those very strong underlying surpluses and the privatisation of Telstra, the Howard government was the only one in the last 30 years that presided over a reduction in the level of Commonwealth government debt in absolute terms and as a proportion of GDP. What is perhaps not as well understood as perhaps it should be is that the very strong fiscal outcomes under the Howard government were the result more of things that happen on the revenue side of the budget than on the expenditure side of it. Contrary to the claims that are often made, tax revenue as a proportion of GDP was higher under the Howard government than under any other government in the past 50 years. Now, that is not, let me emphasise, because the Howard government set about raising taxes. Indeed, as I'll argue and show, the Howard government repeatedly sought to cut taxes. It was rather a byproduct of the fact that we were able to avoid recession and the extraordinary benefits conferred on Australia by the extraordinary rise in Australia's terms of trade, that is, exports relative to import prices, over the period in which the Howard government was in office. By contrast, although public spending was lower as a proportion of GDP under the Howard government than under any other government since, ironically, the Whitlam government, it didn't fall by as much as the popular imagination would have you believe. If I can go on to the next couple of charts, these show two different measures of the year-on-year change in real outlays. The first of them is using the implicit price deflator of non-farm product. That's a broader measure of inflation than CPI. And the second of them is using the CPI as a measure of inflation to produce an estimate of real outlays. And what this chart shows is that government spending fell in real terms in only 1 year during the Howard government's term in office if you use the implicit price deflator as a measure of inflation, and didn't fall at all in real terms if you use the CPI as a measure of inflation. The second chart shows that as a proportion of GDP, while government spending did fall to 23.2% in 1997-98, and again to 23.2% of GDP in 2000-2001, those numbers were nonetheless slightly higher than the lowest percentage that government spending of GDP was under the Hawke government after the two very significant expenditure-cutting budgets over which Keating and then Finance Minister Peter Walsh presided in 1987-88 and 1988-89. And again, as I referred earlier to John Howard's service to the nation during his period as Prime Minister, those were spending cuts that were supported by the opposition rather than opposed by them, as has been the habit of all oppositions while John Howard was Prime Minister and subsequently. That's not to say that the Howard government made no effort to cut public spending, because the level of government spending depends not only on the decisions that governments make, but on a whole range of other factors that influence the demand for both pensions and benefits and various other services which governments provide. Indeed, the first budget of the Howard government, which, if we can bring the next slide up, shows probably more detail than you want to know. On taking office, the Howard government discovered that the budget bottom line for the 4 years from 1995-96 through 1998-99 was $28.5 billion worse than had been forecast in the Keating government's last budget. That gave rise to the expression, the Beazley black hole, albeit, of course, that as Finance Minister, Beazley's responsibility for it was pretty small, but he just happened to be the only one on deck after the Labor Party lost in 1996. The Howard government used this black hole as the rationale for spending cuts in its first budget, totalling almost $27 billion, or 4.5% of GDP over the 4 years to 99-2000, although it did give back about $7.75 billion of that in new spending, much of it, of course, in line with the election commitments it had made in 1996. The 1996-7 budget also included revenue-raising measures totalling $9.5 billion over the 4 years to 99-2000, including the so-called superannuation surcharge, that was partly offset by tax cuts, in particular the family tax initiative that was worth $3.1 billion. The budget returned to cash surplus in the 1997-98 financial year, which was a year ahead of what had been predicted in the 1996-97 budget, which in turn paved the way for the Reserve Bank to start cutting interest rates, having, as John Howard famously pointed out in 1994, raised them by 2.75 percentage points in 6 months. That was the 5 minutes of sunshine that had been enjoyed by Australians prior to that. The budget in 1996-97 paved the way for the Reserve Bank to cut interest rates, even into the Asian financial crisis when the dollar was falling, and was an important part of seeing Australia through that period without it falling into recession, as so many others did. And as Mr. Howard records in his memoirs, Lazarus Rising, the first budget of the Howard government was the most important of all the budgets delivered during almost 12 years in government. It was a very tough budget. It was the best and bravest in 25 years. And he goes on to note that financial commentators widely applauded the budget. I was one of them, and I did. They saw it as a determination by the new government to tackle the nation's problems and halt the growth of government debt, which his government had inherited, which peaked at $96 billion. And I think that's an absolutely accurate assessment of the impact of the 1996-97 budget. But that was the last budget in which the Howard government sought to make serious, significant reductions in government spending. The numbers for the budgets during the Howard government's second term are very much complicated by all the transactions associated with getting the goods and services tax up. And I'm not going to dwell on that period here because the story is too complicated to tell in this time. But I want to look in more critical detail at the third and fourth terms of the Howard government, where, as you can see, every budget resulted in net discretionary increases in public spending, and every budget bar one resulted in conscious discretionary reductions in taxation revenue. Now, many of those increases in government spending gave effect to Mr. Howard's philosophy of supporting families, private health insurance, and pensions, some of which I would personally have been critical of because, in my view, they represented a series of steps away from a welfare system which had as its premise if you were in objective need, you would be entitled to assistance from the government, to one which said in effect that if you met a particular criterion, that is to say you were over 65, you had children, or you had private health insurance, irrespective of any objective assessment of your need, you would get assistance from the government. But while I might disagree with that, it was nonetheless clearly in line with Mr. Howard's stated philosophy. On net, therefore, if we look at the impact of all of those spending and revenue policy decisions taken during the third and fourth terms of the Howard government, what we see is a series of decisions that significantly detracted from the budget position that would have prevailed otherwise. Yet, of course, this didn't result in a series of budget deficits, because those tax reductions and increases in government spending were more than paid for by a succession of windfall revenue gains that flowed from the continued strong performance of the Australian economy, from significant increases in asset prices that boosted revenue from capital gains tax and superannuation fund taxes, and most of all from, again, that extraordinary increase in Australia's terms of trade that substantially boosted the revenue the government collected, especially from mining companies through company tax, at a time when mining companies weren't undertaking a great deal of investment and as a result weren't able, as they subsequently did in the early 2010s, claim very big tax deductions for the capital expenditure that they were then undertaking. So, in effect, what the Howard government was doing, consciously or otherwise, was, whilst delivering headline surpluses and, in the language of the budget papers, underlying cash surpluses and paying down debt, nonetheless significantly weakening the structural position of the budget. That is, if you abstract from the impact of all those fortuitous factors to which I referred before. Indeed, as this chart makes clear, the structural position of the budget before the onset of the financial crisis wasn't nearly as strong as the published figures would have led you to believe. In my view, what the Howard government did during this period, perhaps unintentionally, I'm not suggesting it was a deliberate strategy, was to convert temporary, fortuitous increases in revenues into permanent increases in the level of government spending and permanent reductions in revenues that came back to haunt subsequent governments when economic circumstances changed very substantially during and after the global financial crisis, and again during the period of COVID-19. What these measures also did at the time, if we can go to the next slide quickly, is to exacerbate the inflationary pressures that were then building in the Australian economy, especially during the Howard government's fourth term. As we all know, inflation is rising quite strongly at the moment and presenting a major challenge for the new Albanese Labor government. The headline inflation rate of 7.1% is the highest that we've had since abstracting from the period associated with the introduction of the GST in the early 1990s. But the underlying inflation rate, that's the one that the Reserve Bank actually seeks to keep it between 2 and 3% on average over the course of the cycle, reached over 5% in 2007, in early 2007. And that was, in my view, and I said this at the time, in part the result of the fact that there was a conflict between fiscal and monetary policy in Australia. The Reserve Bank was raising interest rates with a view to keeping inflation within its 2 to 3% target band. But the fiscal policy of the Howard government was adding to demand pressures through repeated rounds of discretionary cuts in particular income taxes and increases in government spending, which wasn't as obvious as it might otherwise have been, because of the huge revenue windfalls it was reaping through favourable external circumstances. In other words, in particular, the then Treasurer, Peter Costello, would say, we're running budget surpluses, how on earth can fiscal policy be expansionary? The truth is that because those surpluses were largely due to windfall revenue gains coming to the Australian government from external factors, and the decisions which the Howard government was making in budget after budget to consciously increase public spending and reduce taxes were in effect providing a form of fiscal stimulus that was adding to the inflationary pressures that were building in the Australian economy at the time. And in the end, of course, that culminated in the 2 increases in official interest rates that occurred during the election year of 2007, including the one that for the first time occurred during the formal part of the election campaign, much to the chagrin of the Howard government at the time. Let me conclude by offering some tentative lessons from this experience. That is the experience of the Howard government in managing the budget during its 12 years almost in office. The first observation I'd make is that cutting government spending is really difficult. Not all government spending is bad to begin with. There is a lot of government spending that meets real, genuine needs and priorities. Most people in this room would put defence in that category without thinking about it. But I think most people would put a lot of other government spending on health, education, pensions, family benefits and other things as things that are important to help create and sustain the society that we want to be. It's especially difficult to cut government spending if the government doesn't have a mandate to do it from the previous election, and Mr Howard will no doubt reflect on the distinction he drew between core and non-core promises in an attempt to justify making spending cuts that he had not told the electorate before 1996 were going to occur. That's a lesson that Tony Abbott forgot in his 2014-2015 budget. It's also difficult to make cuts in government spending if there isn't a burning platform, if there isn't a sense of crisis that makes the public more willing to accept otherwise unpalatable measures, as, for example, Jeff Kennett was able to do when he came to office in 1992, or for that matter, Paul Keating and Peter Walsh did when the currency fell out of bed in 1986 and they, to some extent, confected the idea that Australia was heading towards being a banana republic. A second important lesson is that it's important to make an effort to ensure the perception of fairness about cuts in government spending if they're to be politically acceptable. And that's why, as Mr Howard says in Lazarus Rising, among other places, why the superannuation surcharge was an important element of that budget. From a tax policy perspective, it was bad policy. And it certainly didn't go down well within the ranks of the Howard government's own supporters, but was an important signal to the electorate that the government didn't care about the equity of what it was doing, and I think it helped create more acceptance for the spending cuts than would otherwise have been the case. Third, the particular circumstances in which the Howard government was able to make significant cuts in spending in its first budget are unlikely to be repeated. Ironically, that's because of one of the other important reforms of the Howard government, which was the introduction of the Charter of Budget Honesty that requires an independent assessment of the state of the economy and the budget once an election has been called. It's no longer possible for a newly elected government to go in for a briefing with Treasury and finance officials and come out looking sombre-faced saying, oh dear, those dreadful so-and-sos you voted out of office, they lied about the state of the nations or the state's finances. The cupboard is bare and we can't possibly keep any of the promises that we made. That cannot happen anymore in the Australian context. So it is harder to do that now, ironically, as I say, as a result of one of the Howard government's signature economic reforms. Fourth, the Howard government could, and perhaps from a narrow economic perspective, should have run even bigger budget surpluses during its third and fourth terms in office. The establishment of the Future Fund was an opportunity to do that. And again, it's to the Howard government's credit that it did set up a mechanism for ensuring that future generations of Australians don't have to pay higher taxes in order to pay off the unfunded pensions of generations of retired public servants. I, along with Chris Richardson and Ross Garnow at the time, argued that the government should have gone further than that and established a Norwegian-style future fund, sovereign wealth fund, in order to preserve some of the windfall revenue that came the government's way during its third and fourth terms of office that could then have been used to mitigate the impact of subsequent downturns. But doing that may have been politically a bridge too far. It may have been too hard a political sell. The final point I want to make is that tax cuts and tax reform are different beasts altogether. If it was politically necessary to give away a large part of the revenue windfalls from which the Howard government derived so much benefit in its third and fourth terms, it would have been preferable, in my view, to have done so in ways that improved the efficiency and equity of the tax system, rather than simply cutting the rates at which the existing tax system applied or the thresholds at which they came in. The experience of the Howard government's successful 2000 tax reforms and the less successful experience of other governments in seeking to reform the tax system suggests that it's very difficult to do tax reform if you don't have budget surpluses that can be used to ensure that all the losers are compensated, as the Howard government did with its 2000-2001 reform of the tax system that saw the introduction of the GST. And since Mr. Howard's now in the room, I want to end by repeating something that I said when he wasn't here, which is that one of the reasons why I've had so much respect for Mr. Howard over the period since he was Treasurer is that he's been one of the few Australian politicians who's been willing to engage with people who don't agree with him about something without regarding those people as enemies for life, as many other politicians, including some who served in Mr. Howard's government, unfortunately were wont to do. And for that and many other reasons, Mr. Howard retains my considerable respect and gratitude, notwithstanding the criticisms that I've made in this presentation. Thank you very much, Andrew. Thank you.